lot of startups, some in the healthcare area, some in fintech, sitting on several board seats and actually acting as advisor and operating partner in several other ventures.
Wonderful, wonderful. And I always like to kick off something of a little bit of educational background and something that's interesting. And given your background, I know valuation is a constant one, either valuation or investment. Maybe from the lens you look in, how would you base that? What are minimum valuations when startup? I think just for a lot of them that are starting a company, is there kind of a baseline that you usually look at as a typical startup starting a company, or is it all across the board of some general valuations? When something's like, let's say it's pre-MVP versus post-MVP, maybe might be an interesting way to kick this off, and kind of looking at different valuations, and then what may determine higher valuations in either of those ranges.
Valuation is a very subjective area. It's not necessarily that there is one prescribed number saying that 2 million is a number or a million is a number. It really would depend on the specific product, specific company. We've looked at some where we have been confident or comfortable with valuations in the area of 5 to 7 million. We've had other ones where we've had valuations in the 2 to 3 million range. So it really depends on the nature of the company, what you're doing, et cetera. I think what really underscores that in all situations is the amount of information that is behind the valuation. Conceptual companies, if the idea is really just a concept at this point, or there's no real testing done, there is nothing hard and fast, the valuation tends to be much smaller, despite the fact of how much time has been put into it or the background of the person. It really depends on what's there. Firms that have gone through and done the testing, have proved out the concepts, have, in the case if it's selling product, have sales under their belt, will allow it to get a much higher valuation because it is a proven commodity. It's not to say that we haven't seen companies come to market in either area. I mean, there are plenty of investors out there that are willing to put money into conceptual frameworks very eagerly. There are those that wouldn't put it in unless there actually is something hard behind it. So it really depends on the individual group that's actually coming to market with it. We've looked at all different ones. We have seen it, in a number of different areas. I've played devil's advocate, where some cases I have felt that companies have put out have been valued too low, and some cases I'm not very popular when I say that you're asking for too much. So it really just depends on the individual concept. I mean, that is a very, very individual situation.
Yeah, great. And it's just great getting the repetition. We ask this quite a bit, and it's very similar in the response. So appreciate that, hearing it from you.
No problem.
Also curious, just for the broad sense, if anybody on isn't as familiar with the different ranges, and I know the industry's changed quite a bit in financing. So if you could maybe just walk through the lens you're looking through, what's the difference in the angel investment rounds versus investment banking versus private equity? Like what's typical investment sizes, and how's that shifting? Because it's shifted a lot from where it used to be to where it's at now.
Angel rounds, usually that is what comes just after the friends and family round, or in conjunction with the friends and family. Basically, that money is buying into you, the entrepreneur. They're not buying into your company. They're not buying into anything other than your concept and your ability to be able to put this company together. Investment sizes run anywhere from as low as 10,000, maybe even 5, to probably as high as 100 to 200, but usually never much more than that. Because depending on how it's structured, you could see significant dilution of your investment there as you're getting in. So that's one of the areas where it's generally in the 100, 200,000 range. When you're talking about Series A, Series B, Series C, these are proven concepts. These are companies or groups that actually have proven what they're doing. They have a track record. They're raising funds. A Series A round where an investment bank or a private equity firm, large family office, et cetera, might make an investment. The average sizes there probably run in the range of $500,000 to $1 million. I mean, cases you may cut it a little bit smaller if it's a friend or family, but those rounds usually are between, you're raising between 5 and 20 million. Round B is where you're starting to see the real heft, 50 to 100. Round C, 100 or more. So, early numbers are very small. And again, the issue gets down to, it all gets down to, from the investment standpoint, how much risk are you taking and how much dilution can you afford?
And that's super helpful. And then curious, what are you typically looking for as a return? Just so that they like, I know a lot of times it's looking at like a 30 to 40% return, or sometimes it's a different expectation than an entrepreneur thinks a return is than what is actually looking for a return in an investment strategy.
If you're getting in on an angel round, you're probably looking for a return of 4 to 5x of what you put in, because you're really getting in there early and putting in the money. In a round A or a Series A, a Series B, returns are probably coming in somewhere to the degree of 20 to 30%. By the time you're getting to Series 3, you're looking at, 10 to 20, a fair return. Because at that point, the business is ongoing and it's running well. Certainly, the earlier you're getting in, you're expecting much more because the risk is much higher. On an angel round, for example, you put in 100,000, you're going to probably be looking to take out a 4 to 5x. The reason being, you're running a 50-50 likelihood of losing your investment. So the returns are much higher. But by the time you're at the B and the C round range, a 10 to 20% return is probably a fair number.
Right. And then I know Doug had a question. And again, if you guys have questions, go ahead and type your questions in, or let you know. We can start answering questions. It's great to have Robert on answer on fundraising. But Doug said, is it unrealistic to try to raise 100 million for a Series A?
Yes, it is. It's not that I haven't seen it done, but usually Series A, I've seen money raised comfortably in the 50 million range. Now, I can tell you from experience, I've worked with a company last year that raised 100 million on their Series A. They came close. They came in at 93 million. It was well thought out. They had a great management team. The concept was really spot on, and they were able to do it. It's doable, but it's optimistic. And it would really depend on the management team and the concept that you have. 25 to 50 is about the average, but I have seen it go to 100. 100 would definitely be the outside.
And then I'm going to unmute you, Doug. I know you had questions for us as well. I'm actually not able to unmute you. I think you got to do it on your side. But I know you had questions on, I know you're wanting to start an insurance company, and yeah, it might be good to pick Robert's brain for a second and ask him his perspective on it, because he may have seen insurance companies that have been funded and the angle that you're trying to do, and just try to help you, give you a perspective on what you're looking at.
Yeah, right. So I'm trying to start a new type of insurance fund and company. And, so for insurance, 100 million is kind of really small when you're talking about a new type and a new fund. So how do I go about moving in that direction? And one, finding people like you that have an immense amount of experience investing, because that's going to be, a big portion of what we do as well.
When you're saying insurance company, you're going to be doing underwriting, or are you going to?
Yeah, we're going to be doing underwriting, and we're going to be managing a new fund.
Okay. This is not. I'm sitting now on the board of a de novo insurance company now, and the goal is to raise roughly, or issue actually equity in the range of about 100 million over the course of the next year. The difference there is they're looking to actually do acquisitions of existing standalone companies and build up the portfolio that way. Issuing a de novo product, i.e. you're going to be doing the underwriting, you're going to be setting up the fund for it, is going to be a little tough depending on the team that you have. Now, if you're telling me that the president, CEO, the management team is going to be all ex-insurance executives that have 20 plus years of experience and can cite the track record, the 100 million is doable, depending on that. It would really depend on the thing. With insurance, it's heavily skewed to the investment portfolio, like everything else. And the insurance company's assets are the investments that they have that support the future payments. So it's really thinking about it as a pass-through of from one investment to another. So I think that in the product that you picked, it can be done, but you're going to really have to have the management with very, very significant depth of expertise. You're probably going to want to raise that funding not from the family office issue, but more of the institutional investors. So the pension funds, the endowments and foundations, the types of investors that are looking for a significant, prolonged, ongoing return.
That makes great sense.
Awesome. And that's it. It's just stacking, right? It's some of the same things. Like I think Steve had said there, traditionally 50-60% of the weight of the investment is based on the executive team and how well they can execute. It's seen it on the big level as well, on a large scale level as well.
And one thing to always remember when looking at the investment team, and it's very tough, particularly starting any type of new organization, the investor group is going to look to the team not only in terms of their experience and expertise, but also how long have they worked together. If you can say, well, we've lifted this team from XYZ fund, XYZ firm, et cetera, that goes along a much longer way than if you say, well, you've got this senior executive from this company and this from Y and this from Z, but this is the first time we're working together. There's always the skepticism about, how has the team or how will the team perform together. So any type of longevity that you can cite, working together as a team and working together as a group, showing the symbiosis between that group will put you in a better stead.
That makes sense.
Oh, there we go.
I'm still working on building out that team, so I'm,
As you build it out, definitely keep that in mind as you're doing it, because these are some of the pitfalls that other companies. It's not insurmountable. It just makes the ability to raise capital a little more difficult. You always want to try to figure out those issues early on. Try to make it it sounds trite, but try to make it as easy as possible for yourself.
Right.
Awesome. Is that helpful, Doug?
Yes, thank you.
Okay, great. Next, I'm gonna unmute you, Max. Going over to Max. Where you at? There you are. I know you'd said for funding on convertible to equity document, how viable is no cap? Maybe could you explain a little bit more what you're
basically, there's a lot of talk from the side of investors that they want to.
Real quick, too, just so Robert has some background, we'll do this in any question, just name and a quick 30-second elevator pitch so he has a context of your business as well.
Okay. My name is Max. I'm from Los Angeles. The company I'm working on is basically with all the electric vehicles that about in the next 10 years completely dominate the market. The issue in the network electric grid exists that it's just too expensive to provision every vehicle to have dedicated connection to the grid, and our product is solving that issue and allowing to basically charge 12 times more vehicles with the same amount of amps delivered to the location. So from the standpoint of investors, they always keep saying, "Oh, we got to put this cap in a convertible document." Um, and a lot of people on founding teams saying, "Well, that sounds like evaluation that you're trying to piggyback in without doing evaluation and restricting our growth potential, well, and improving your upside." So I'm just trying to see if you've experienced a lot of uh, directions from both sides. What have you been seeing uh, of people trying not to put caps on convertible documents?
That's a very good question, and it's one that a lot of startups usually run into. What I have seen recently, and I can cite someone that I've actually been talking to this week. They've been raising money with the use of a safe, which is basically a convertible note that doesn't give a valuation on the upside. They've always tried to use that as much as possible because it allows you. It talks about a certain amount of equity that will be given to the investor, but it doesn't put that valuation cap, because the risk you always run is that you're selling you're putting the cap too low and you're giving away too much equity in the beginning. So what I have found are that the safes tend, at least at the early stages, work very well because it still allows you to raise the equity capital, but not actually cap out at a level until you're actually 100% sure of where you think that valuation should be. As of using a safe as opposed to, a convertible note.
Yeah, and how much pushback have you seen, if you have experienced that at all, from the investors basically insisting that we're not going to invest unless there is a cap?
I've seen some pushback in the later stages. If you're looking in the beginning, usually because it's coming early on, you don't get much, but you'll start getting that when you're probably ready to go to start getting angel money. You might actually get a little bit of a pushback there, and maybe even not as much. You'll start to get more of it in around A, but usually right in the beginning, there's not that much pushback on it.
Is there any advice or notes in terms of how to mitigate, how to explain to them that it shouldn't be there?
That the valuation shouldn't be there.
Yeah, in a
Well, I
convertible
mean,
document.
normally in the document, it just, you basically state that it's just at this point just too early. It's a matter of just knowing who the investor is. Clearly, if it's a third party arm's length investor that doesn't know you, yes, they may want to force a number, or not be unwilling to put the money in without that valuation. But if it's someone that is reasonably comfortable with you, or knows the background, or knows the product, etc., they'll be more understanding of that. So I'd say, at that point, you should be careful, as when you're picking the investors, make sure that they are more of the group that you're familiar with, or you have a warmer relationship.
All right, thank you.
You're welcome.
I'll just comment on too. I've invested in a couple companies with safe notes, and again, I was banking on the CEO of the company, and it's gone up in value. I mean, I've seen them go small to big. I mean, the valuation changes quite a bit, but it's really basing on what they have and kind of looking at the data, and it changes. So that's the beauty of safe notes, is you can just change the valuation as you grow. So I've invested them, and a lot of times they've used that to say, hey, I got this thing coming up next week. As soon as we get this next piece, it's going to go to this valuation. And that's kind of how they framed it, as like, I'm going to give you a 20% discount on this one, but as soon as the next one goes through, it goes to this. And then so you're kind of banking on that. So that might be a helpful strategy as well, Max, if you're lining up a couple deals, or you're doing like a small roadshow of just saying like, hey, once we hit this much in investment, it's going to go to this valuation. And that might give them some other incentive to come in a little bit earlier.
All right, thank you.
Okay, great. I know Jeff had a question about the time period. When we were talking about returns. he asked, what's the typical time period that they're looking for a return within? When you were talking about, maybe 40% for angels, and then maybe 10, 20% as you get further up into that. What do you typically see as a time frame that investors are looking for that return?
Usually no less than 5 years.
Got
Yeah, it's usually when you're, particularly at an angel round, you have to assume that it's going to be at least a 5-year time horizon before you get it out. Anything before that is a bonus. But the normal standard range, at the angel and the A level, you're looking at about a 5-year return. I mean, in most cases, if it's purely an investment fund, it would probably have a 1-year lockup anyway, so a minimum of a year there. But that would be more for the round B, round C, even round A. But for the angel, you're assuming that you're going to be in there for a while.
Great. And then it doesn't have a name right up, but it says PLJ. Any other question? And I can't unmute you. You're going to have to mute it on your end. You were talking about Series A for dictating valuation. Just curious what your...
Yeah, this is Peter.
Oh, Peter. Okay, great.
Yeah, sorry about that.
No worries.
Yeah, so basically, don't you let the Series A investors dictate valuation? I mean, I've been involved in a couple of, seed to A to Bs and Cs, and we've always tried to avoid the valuation question around the convertible notes and just let the Series A dictate the cost per share, because that's an equity investment. They're purchasing equity, not necessarily writing a note.
You're correct. You're absolutely correct. We have any investors will always try to push a valuation early. They want to know exactly what they're getting for their money. So there's always the push there, with the understanding that yes, it is an unknown, but they're going to push anyway. You're spot on when you say that the Series A usually does dictate that, and 9 times out of 10, you will rarely see a valuation before you get to that. I've seen valuations earlier, and that's usually in situations where it's a bit of a desperation move, and just the money is needed. You can't go in without it. There's no more capital for the founder to put in, so they're going to have to go and actually draw the line in the sand. But you're exactly right in your thinking there.
Okay, thank you.
Mm-hmm. Thanks, Peter. Okay, Allison had a question about what are the markers that it's time to raise a seed round? And you want to expand on that a little bit, Allison?
Sure. Hi, guys. Nice to meet you, Robert.
Hi, Allison.
My name's Allison, and I'm CEO of RSVP, which is a social network that is event-focused, and we include ticketing that's built into it. We launched our MVP in August, and since then we have about 400 users. We've listed around 100 events. We just did a first ticketed event last week, and it went really well. We were able to pull our developers together on the fly to account for bugs and evolve the product quickly, and it went super well. So I mean, we're still pretty new and we're bootstrapping. I imagine that we actually waived our fees on that first event just to do a trial. Mm-hmm. So we don't have revenue yet, but we made some great learnings from that first experience, and we're improving our product. And so I'm sort of wondering at what point, how many users and how many, how much revenue do we need to show to sort of prove to investors that, our concept is working?
Well, I think that WeWork would be the classic example of showing that you don't need to make money in order to attract investors. It's in the paper every day. But no, I mean, honestly, if you're showing at least a progressive move in terms of revenue that's coming in, and the business plan spells out the milestones that you are looking at. For example, X number of dollars in year 1, 2X in year 2, 4X in year 3. That will go a lot further. And if you're explaining where the crossover goes from a loss to a profit, as long as there is revenue that you are proving that can be stratified and can be expanded upon. Once you're showing at least that the revenue's coming in, you've basically drawn the line that you are an ongoing concern, and you can do that. But you need to be very explicit in the business plan in showing, this year we've got 100,000 in revenues with 4 customers. Next year we expect to increase that to a 500,000 in revenues with 20 customers by implementing marketing plan. If it's articulated, it's mapped out, and it's there, you can do that. I would say that you probably traditionally a year or two of zero profit is fine, unless it's the flavor of the day, an Uber or a WeWork. But at the end of the day, we've seen that the bloom is off that rose. But in a standard average startup, you probably have about a 2-year grace period, but you need to be showing a significant and a calculated set of milestones that you're looking to achieve.
Awesome. That's super helpful. Thank you.
Okay, great. So thanks, Allison. Doug is asking, I was thinking about this too, so I'm glad you asked it, Doug. I've been hearing about funding opportunities for startups that dwindle over the coming months. Can you comment on that? And should startups seeking funding increase efforts? Are factors, the economy, upcoming election, are there other factors that are affecting that in the near future?
We have just been through a very interesting time over the last couple of months between the Uber IPO and the shelved WeWork IPO, which is really going to put a damper on a lot of the startup market. What you have witnessed is, let's say, the wholesale implosion of the market, similar to what happened in 1999, 2000, except you didn't have a bunch of individual investors taking the hit. You had the risk, the inside investors taking the hit. If you're a fund, if you're a SoftBank or an investor, that's the risk you take. No one will shed a tear when you lose the money versus going out in the wholesale market and having it implode. So as you could see, it really didn't affect the market that much. But what it did was have everybody sit back and take a look at where they are. I mean, Uber went through and issued an IPO, and it was beautiful. And then WeWork came along, and things started percolating there before they talked about it. And all of a sudden, the Uber valuation started going down. So the scrutiny and and all these new startups are going to be under the microscope much more this year. I think more so because of that. Over the next year, the microscope will be on any startup or anybody looking to raise money saying, is it viable? Will it make money? How is it going to make money? The old concept of, it will eventually make money is no longer palatable. Now, the other factors we have, impeachment trials, elections, a change in administration, this will always affect the market to a certain degree, although I don't think it will affect it that much. I think because at the end of the day, the changes that will be going through, if there's a change over in administration, will be at the upper ends. The taxation will not be hitting the startup companies, and I don't think it will change the overall financial environment that much. Wall Street won't be happy about if the elections go one way or another, but at the end of the day, there's always a way to get around it. So I think that those factors are secondary, but I think, in my opinion, what has happened over the last 6 months with the unicorn IPOs that came through is really going to put a damper on it. So it's going to force the new fund, the new startup, to be very rigorous in showing their numbers, in showing the business plan, and making sure that these goals are achievable. The euphoria is gone, and unfortunately, these two big IPOs have really dampened it for everyone else. But it's not to say those are the exception more than the norm. It's just going to put the onus on the more modest and moderate startup to just make sure that the numbers actually that are underlying the concept are there.
Great. Did that answer your question, Doug? I have you unmuted.
Okay. Yeah. So what it sounds like is because of the Uber and the WeWork that this may kind of blow over in a relatively short amount of time, like a few months, but then the upcoming election and those other factors will probably bring in a new scenario.
Yeah, it will, but the I don't think the Uber WeWork situations are going to blow over that quickly. Everyone's going to continue to look at it and say, you know, oh, there, but for the grace of God go I. I mean, we don't want to get into another situation there. And I think investors will be much more critical when looking at startups and looking at de novos to put money into it. The election, we're always going to have an election. Things are always going to change. We're never going to have 100 years of Democrats or 100 years of Republicans. This is the United States. We throw them out as fast as we bring them in. So it works in the short term, but I think what you're going to continue to see the blowback from. I mean, I'm old enough to remember 1999 when the market collapsed. There, it was years before startups were able to start making it on their own. I don't think this is that as bad, but it will continue to put a damper on it. Again, if it's a good company, if it's a good concept, if it's a good startup, you're going to be able to do it. It's just that you're going to have to prove yourself a little bit more. Don't worry so much about the election. It's as I said, we're the greatest republic in the world. It's gonna change. I can guarantee you that. Which way, I don't know, but it will change.
All right, great. Thanks for your comments.
Awesome. Cool. Then I know we had a question from Joel. Joel was talking about crowdfunding. So curious on your thoughts on crowdfunding platforms like WeFunder, Seed Invest, Crowdfunder. When are they usually a good fit and when are they not? Product, service, and company stage. Your thoughts on that?
I'll be very honest. I'm not the expert in crowdfunding, but I will tell you they serve a purpose, and I certainly would make use of them where you can. For the very small startup, for the business that normally wouldn't have an appeal for the wholesale investor, the large family office, the institution, the pension, et cetera, it's very hard to go out and get funding other than loans or friends and family. So the crowdfunders do serve a purpose there. Again, you're still going to be held to the same standard of proving what you're doing, but at the end of the day, you're not spending a lot of money on lawyers and bankers, et cetera, to do that. So depending on your size, I mean, if you're looking to raise 100,000, 200,000, 500,000, those crowdfunding sources work very well. And I think that, startups in the smaller end of the scale should definitely take advantage of it. And, there are people who would be willing to invest $50, $100, $500,000 into something that, listen, it's like a day in Atlantic City. If it works, great. And if it doesn't, I'm not going to lose the house on it. I'm not going to be happy, but I'm not going to lose the house. But you could cobble that together, quite, particularly in the early stages, quite quickly. And, you'll have some very happy investors. So depending on your size and your ability to mine that market and understand it and get your platform up on it and raise the capital, my feeling is go for it.
Just to speak on it a little bit as well, Joe, I've done a little bit of research on it, and you also, it's definitely some work. It's definitely a lot of work that it takes to get a list together, actively reach out to the list, and to keep that momentum going. I've seen a bunch of people do it really successfully for products. So launching new products. I've seen it for film, are kind of two industries that I've seen it work really well for, at least from the research that I was doing on it. That's where one of the areas I was looking at for a film I'm working on, just because of that piece. But did you have other questions about that, Joel?
Yeah, it's funny, Josh. I've been following Legion M, and they're raising a lot of money and own a piece of Hollywood through their community. And I feel like what I'm doing is similar, but it's not exactly a product yet. It's more of a community. So, Robert, I'm wondering. So my particular market, my company is One Great Gut, public PBC, Public Benefit Corporation, B Corp, and my particular niche right now are those living with Crohn's and colitis. Competition is the leading nonprofit in the space. Crohn's colitis, inflammation America. Everything that is allopathic is thumbs up. Everything not is pretty much quackery. And so I'm curious your thoughts on, you started off your answer with why if you're not a fan of those sites. And I guess I'm a little ignorant. What do you mean by wholesale? I'm trying to figure out where I have a pretty big community. I mean, I have my community is probably around 20,000 of those living with IBD around the world. And, what's the best way to communicate with them while also leveraging the 97% of the 10 million I have not yet touched?
When I was saying wholesale, I'm talking about the wholesale money, the pension funds, and the like, pension funds, the endowments, foundations, investment groups, et cetera. That's where, the investment sizes would be in the million, 2 million, 5 million, 10 million range. But if you're saying that you're trying to reach out to the community, and I didn't say I wasn't a fan of crowdfunding, I was saying that I just don't know enough about it. But I do think that it works for certain areas. Now, you're starting up, and as you were saying, your competition would be in the charitable side. Basically, I think that the crowdsourcing would be the perfect venue for you, because it allows you to tap into the smaller scale investor, smaller scale capital that's going to help you, push this along. And you've got a 20,000. How do you do that? I mean, I know some of and again, I don't know much about it, but some of the crowdfunding sources that you can put it together where you tap into their network, and anyone that's on their network that says, I want to see products in technology, medical science, digital health, et cetera, as you sign on to those platforms, you will pop up on their radar screen, and you'll have reverse queries, so you don't have to actually go out to them. Mm-hmm. But as I said, I've not done it before, so I'm not really the expert in that area. Got
it. One quick follow-on question. So you really opened up my eyes here with families and foundations, investment groups. Is that a scattered thing, or is there like a resource, a place where a lot of them, are a part of, so you can just reach out to one place and have access to many people to be able to communicate to? There are a number of pay-for-play platforms that will give you a list of family offices, foundations, et cetera. They're not cheap. They run several $1,000s to get the databases, but that's one easy way to start. There are trade groups and advisory groups where Family Office Network is one that comes to mind, where you can just go online and get in there and see who is a member and who isn't. Some of them publish their client lists, others don't. But the easiest way to do is just start a plain Google search and just put lists of family offices. I mean, there are some databases out there that are public and allow you to tap into it, and then some will make you pay for it. It depends on how far along the lines are you willing to pay, but I think you can probably get a lot of resources just online. It's just out there. Great. Thanks, Robert. Appreciate your guidance.
Yeah, and then I saw Jeff's question in regards to the same question. And I know Indiegogo, Kickstarter, looking at the ones Joel did, I think the ones Joel is looking at are more equity-based, mm-hmm. Or actually wanting to do like more of a traditional. And I think Kickstarter, Indiegogo are a little bit more product-based, or like focused on a specific thing. So hopefully that answers Jeff. And I'll leave that to you, because that's not my area of expertise. And it's not mine either. I've just done some research on it, but there's a bunch of options out there as well.
Yeah, that's my understanding as well. I was chatting with, I think it's Clay Herbert, who's, I guess, an expert in the space of raising money on platforms like Kickstarter, Indiegogo, and he advised that's definitely the wrong place for me, because I don't have one product that I'm building out and pushing. But then again, my friends at Neurohacker, they use WeFunder and they have a product. So I don't know, I haven't done much research myself either. My feeling with crowdsourcing is cast a wide net. I mean, you don't know how, which is going to work. I mean, obviously some are better than others, particularly in what you're doing, but I would definitely say cast a wide net and, check them all out and see what makes the most sense. Great. Thank you.
Okay, cool. Next, going to Padhu. And I wanted to unmute you just to get a little bit more clarity what you were asking around this. And where are you at? Oh, there you are. Can you hear me?
Hi. Hi, Albert. Can you hear me?
Yeah, I can.
Yeah, cool. So this is my first online session, and this is my first towards the,
Got this is your first one. Great. Well, why don't you just introduce yourself to the group as well? Just, and again, when you're introducing, name where you're calling in from, and then your elevator
Hi
pitch.
guys, this is Padhu, and I'm from India. Right now, I'm working in Poland, and I recently started exploring about online investment and startups and all. And to give the heads up, this is my first step into the research. And my question is, so I have like a lot of project ideas at the conceptual level, and I want to start like a little step at the time, since it is very, very new to me. And I wanted to start a virtual team. And so what are the key factors you guys look into someone who don't have much experience and who wanted to step in?
This is, you're talking about for yourself or for people to work with you?
Of course, for me. Example, if I want to, get some funds, and I wanted to do it in a virtual team.
Putting together a team, particularly a virtual team on any project, involves a little bit of sweat equity. What I would say is, in terms of getting funds, at that early stage, it's really, you're reliant upon yourself and your team to do the funding, whether that means you're putting in the money yourselves or you're working pro bono. But at least in that first 6 months to a year, a lot of that is going to really be reliant upon the team.
Right.
You would really need to identify who what the product is, what you want to do, who you're going to work for, put the team together, and whether you're doing it concurrently with your ongoing employment, or you're using, saved funds, whatever. But a lot of that is going to be, until you have the concept up and ready, you won't be able to start raising funds until you actually have that team together and some either product or some strategy, up and running.
Cool. My question is since I have these projects all at the conceptual level, and I need to start a team now. And to start the team, I want to bring a very, very a top guys in separate fields. And to bring those top guys into the team, I need some funds. And so is this something I can able to do, get some investments?
Yeah, so here's how I'll comment real quick on this piece too. What I'd say is a big part of it's communicating your vision and having the right vision that people can buy into, really mapping that out. And in the Accelerator, we give you a pitch deck. There's a bunch of resources. I don't know if you've had a chance to go through a lot of the content, but really working on how do you communicate your vision through your pitch deck, I'd say is an easy way to get started in enrolling people. And there's also one on finding co-founders or team members or advisors to come into that. But again, early on where you're at, unless you already know them, my experience has been
no, I'm completely.
So I think a lot of people would love that as well, to find really top talent to help them execute their idea. And the challenge is, this may be something you're working on for the next number of years. And again, and so it's a constant practice, but the better you get at communicating what you're doing and kind of that initial pitch deck, if you will, 12 slides, here's my concept, and keep working through validating it. So again, again, as a solo entrepreneur, you start off and everybody starts kind of in the same boat of here's where I'm at, here's my vision. And you start to work through the concepts. What I would say is, if you haven't done some of the validation pieces, I would invite you to work on those pieces first, because let's say you do enroll a team and then when you go to validate and it fails, it's a little bit of a tricky spot, right? So if you could just work through a little bit more of, this is the idea I have, this is how I need to validate it to make sure that it's actually an idea that'll work. here's how I'm going to prove it through the MVP process. And as you start to work through that, like you may find out the concept doesn't work. And I think as an entrepreneur, we're so optimistic. You know, we think an idea will work because we see the problem. We're like, this is going to work everywhere. And we want to run fast. But sometimes in the beginning stages, as hard as it is, being patient and validating through research and studies and data and getting that like, okay, this isn't just me and my concept, but this is an actual product or service that can go into the marketplace and it solves the problem and people will buy, really helps solve that piece. So my invitation would be to work through that, a little bit of the deck and working through those initial stages of validation. And as you're doing that, there is other tools like prototyping tools and other things. Is it technology you're building?
Yeah, of course. I'm in a software field and yeah.
Got it. So your background software.
Yeah, of course. I have like a lot of other concepts as well, but I first want to start with the softwares.
Got it. So it's, and again, if you have a bunch of concepts, maybe it's looking at 3 or 4 ideas and saying of these, which has the, also looking at the market size, like the market potential, I think is another good kind of concept of like, you might have an idea, it's a great idea, but it's a lifestyle business because it's only going to capture a small percentage and some may capture a large percentage. So kind of assessing those first.
Yeah, just to give a heads up, I'm like a complete new beginner here. I even didn't got chance to go through our basic tutorials. Yeah.
Well, great. Well, great. I again, this is what I want to welcome you to it. And we've created the content portion of it as step-by-step as possible. So there's literally step-by-step videos, workbooks, even just that first module. It'll walk through the whole startup journey and some of the language I've been referring to. If it doesn't make quite sense, it'll start to make sense in mapping that out. But I want to welcome you to it. And I think just joining the community helps you start to get familiar with the language, the terminology, and what everybody else is going through as well. And I'll say one of the most common problems I see, at least from my perspective, is people try to run too quickly without the validation. So that's why I even appreciate Robert's insight on that validation, because it's really hard to raise capital until you have something in place, because that's where most companies fail. That's where the failure is. That's the greatest risk. And that's why it's so hard to do. So.
And one thing to remember, I know you wanted to attract some high profile names as to give you a bit of a, to put the imprimatur on the company. But remember, with those big names come big risk, not for yourself, but for the person in general. If they're going to come on board, even if you're going to attract them with money, if they don't feel that the concept is there or they don't buy into it, you may not even if you had the funding, you may not be able to attract them. They may look and say, whatever he's going to pay me, the professional risk or the reputational risk is too high if I don't know the concept, the foundation, the company, etc. So yes, it's nice to have that household name on the team, but at the end of the day, don't sell yourself short, because if the product is good, people are going to go for it regardless of who's doing it. And I try to, when I am either being brought in as an advisor or if I'm acting as a director, in many cases, I will try to put the brakes on the entrepreneur from spending too much money and worrying about, well, we have a person from XYZ and they're going to do this, this, and this. Remember, if they're coming out of Apple, working at a startup is night and day. But if you get a person who was working at a startup that was successful there, that's the person you want to attract. So don't get overly hung up on, it's like branding. Don't get overly hung up on the branding. You're the best brand that you have. And if the product is good and the concept is good, it'll sell itself. You don't need to spend the money on it.
I completely agree with your concept and advice, but the idea about my your question is, I believe not just with the names I'm bringing in, I have a good basic concept, project concept, and to be very successful, I want to make it like a perfect in all the corners. And to do that, I want real talents. And that's why I wanted to bring someone who really do the job better. And it's not about I bring them and the product will win.
Okay.
What time is it in India right now?
I'm in Poland right now. It's about 8
p.m. Awesome.
Cool. Thank you, Robert. I really, thanks for your answers.
Yeah, just on the same note, Jill had asked defining validation. It's a great question. I think validation is just enough data to prove, I guess for me, there's multiple validations. So this is where it's a little bit tricky. You're validating that there's a problem. You're validating that there's a need. You're validating that there's an MVP and people are willing to buy it. As you get further along, it moves from validating that this is a problem that people want to solve to more of product market fit is where that kind of evolves to once you have an MVP and you're trying to prove that product market fit. But typically the basic concept is, I have this idea. How do I prove that there's actually other people that have the idea and that it's actually achievable to happen? And again, it can be done really easy with landing pages, surveys. It doesn't always have to be this big thing that's done. Just enough use cases is a common one where you get out and get enough interviews of people, open-ended interviews, not just directing them, but like asking open-ended interviews to prove it. And then how do you actually execute a solution for that is really the MVP. Okay, now that I know that there's a problem and I validated it through this type of data, now how do I go build some sort of prototype product, service, something to solve that problem and prove that that problem will work? And that's where you're getting on product market fit and scalability and how that really kind of scales to meet your goals. And that's where it gets a little tricky because your goals have to make sense with what you're raising, right? So that's where it all kind of ties in. If you have a $100 million business, but there's only a tiny little market share, $100 million total market share, right? Things start to not make sense. So does that make sense, Joel, with what you were asking as well, just to make sure you got that? This is a good question for everybody in case there's any clarification on that. Let's see, just make sure you can hear me okay.
Can you hear me now?
Yeah, I can hear you now.
Okay. It does make a lot of sense. I appreciate that. I mean, I've done the landing page and I've put on big events that had thousands of people come, but they're not scalable events or products. So that's where if I look at your runway there, I may be at, there's a need for a problem and I feel like I've solved it with, I mean, you know my story, right? It's like with like the Crohn's and Colitis Summit and the One Great Gut Collection solve the need, but those aren't scalable things. Those were product launches. It's not something that I can sustain and build out.
Yeah, so I'd say that's where you're at. You're in the MVP to product market fit. Like, okay, I found some great things that work for my market. What's a scalable business model that I can create to really have an ongoing solution that's solved and something that'll reach, like you said, there's 10 million. How do I take a larger chunk out of that 10 million with a scalable model that makes sense long term? I think that's where you're at in the framework. Does that make sense?
Right. So then per definition of this world, I don't have an MVP yet, correct?
I mean, I think the fact that you validated through a couple summits shows that those are definitely MVPs. But if you're wanting to raise capital, you have to have the plan. Like, I'm raising capital because this plan is going to go to market and this is how I'm going to, like, it's almost like you've already figured out the details. You just need the cash to pull the trigger is a little bit how that conversation works. So if you're like, or if you're saying I needed this to build the product, but you're super clear on what that product looks like and there's enough validation from it. So it could be either one. You could say, hey, I've got this big community. There's a big need here. I've solved it through these multiple ways, but it sounds like you need to get really clear on what's a long-term business model that you can scale and maybe looking at other business models. And that's something that I do sometimes is I look at other models and other channels or other industries that are different than mine to see what could be applied to that. A friend of mine, Brock Pierce, has been very successful in crypto and a lot of other industries and gaming. And that's one of the strategies he used is he looked at other industries. Like he created buying and selling and he looked at gambling and said, gambling's a massive industry. And then he looked at gaming and said, I wonder if there's people that are willing to play games all day and people that want to pay for it. And he created that whole currency system by taking what was done in gaming and put it like gambling, and put it in gaming. And then he went up and bought a bunch of games, put up big centers in Korea and all these other countries. And he basically created a whole marketplace, right? By thinking out of the box like that.
He's the guy in Puerto Rico?
Yeah. He's big into crypto now.
Funny, he just messaged me. Okay, cool. So
business model. Yeah.
Yeah, appreciate that. Okay, thanks, Josh.
Yep. And then I know, Ramiro, you had a question on crowdfunding, a final question on that piece, right?
Yeah. Okay, Ramiro Montesioca. My company is Athink.io. It's modular electronics. It's Legos for electronics. Part of the problem that I have, trying to raise funding is I want to do a Kickstarter campaign. And this happened 6 months ago. There was an investor who told me, hey, if you are going to make a Kickstarter campaign, don't try to raise capital because there's a contradiction, or try to do a Kickstarter first and then try to raise capital. The problem is, and this is the catch-22, we need at least $500,000 to manufacture the chip, which is not cheap at all. And a Kickstarter campaign will make it because the way it works, when you manufacture a new chip, your break even is in 1 year, basically. So the question is, I mean, what is your advice on trying to raise capital first and then trying to go to regular crowdfunding?
I think you could do that, and that's the more traditional route. In fact, you may not even have to go to the crowdfunding area if you're successful on raising the capital. But what you've described is basically what we in the industry would call a friends and family round. I mean, you need to tap your entire network of people that know you, your abilities, the product you're pitching, and raise the capital from those sources. It's like we had talked about in the beginning of the dialogue, in that, you know, they're buying into you, they're not buying into the company yet. So this is purely a chance. So yeah, if you're not going to go the crowdfunding route and you need to have that cash, I would, you know, try to do it along those lines, and you could structure it either as a convertible, as a note, convertible note, a safe. There are any number of different ways to do it, but you can easily raise the couple $100,000 that you need to get that those chips into processing. But you're going to have to really tap the network yourself and your partners in people that are willing to stake a financial claim on your reputation and your ability to deliver. But that might be a lot easier because you're known to them than going the traditional crowdfunding route.
Well, I was more thinking doing actually crowdfunder. It's the perfect platform for us. And we work on the defense industry. It's not like, you know, we don't know what we do. And so we have a really good reputation on what we do. And so anyway, I was trying to go in that direction anyway, crowdfunder.
I mean, listen, it definitely works. It can get you where you need to go quickly. If you are comfortable that the name recognition of the company, and particularly in the industry that you're in, will allow you to tap the resources to make use of your name and your reputation and your history behind that, by all means, I would say, you know, raising capital is a numbers game and a time game. I've seen plenty of very good companies and products not come to market because they just ran out of cash and the ability to raise it. The clock ran out and they couldn't get it on board. So, you know, you need to take the path of least resistance. And if that's going to get you there quicker than pounding the pavement and working the phones, by all means, I applaud you to go and do it that way, because you just
and by the way, we're going to be on CES this next year on Eureka Park. And, you know, the first day is everybody's or media or investors. So we want to catch the first wave with investors, and then we go to Kickstarter. But okay, I think we're running out of time. So
yeah, you've got to go where, yeah, I said, take the path of least resistance, get it quick.
Yeah. Thank you.
I just want to thank Robert for joining us today on the call. Thank you so much. Robert is an advisor on our platform. So I sent out a link if you guys want to do a one-on-one session with Robert. Email Casey. We're about to get this up and running next week, but in the interim, email Casey and he'll get you connected. And thank you, Ken. Thanks for joining us, Robert. Really, really helpful information. I know everybody's aspiring entrepreneurs, and getting ever to pick your brain and answer those questions was really helpful. So thanks so much for joining us.
Very helpful, Josh. In fact, I spoke at a Columbia University seminar back in September, and the one concept I used, which actually got a bit of a laugh, I'm like, you know, particularly with the startup or a new company, you know, it doesn't matter if you're building the world's best mousetrap. If there are no mice, you don't need it. as long as the product is needed and it's good and the market is there, you can make use of it. You have to just understand, how big the market is and what you're going to be doing. But if you've got a product and there's uses and there's the ability, it's a numbers game and it's a time game. You just got to, you have a thick skin, keep pushing ahead, and just believe in yourself, because no one wants to invest in a company or a concept where the owner isn't comfortable with it. You've got to exude the confidence. You got to be happy with what you do and be behind it 100%. That's the half of the game right there.
Super helpful. Really helpful. Awesome. Okay. Thanks so much, everybody. And again, I'm sorry if I didn't get to all the questions. Charles, if you guys are on Slack, you could shoot a message on Slack. That's a little bit easier way to get it. But some of the questions were tied in on the questions we were asking, and wanted to make sure we got those. So appreciate everybody joining today, and have a great week. And again, make sure you're using the Slack channel. It's a great chance to get connected to everybody and get answers and get other questions answered. So thanks again, Robert. Thanks everybody for joining us, and everybody have a great week.
Have a good day, everyone.
Bye-bye.